The Federal Reserve enters 2026 facing the most politically charged environment in its 112-year history, with a landmark Supreme Court case set to redefine presidential power over the central bank and a looming leadership transition that could fundamentally reshape American monetary policy. As the nation's most powerful economic institution navigates unprecedented political interference, the stakes have never been higher for both Fed independence and the broader American economy. The immediate drama centers on the Supreme Court's scheduled hearing on January 21, 2026, to determine whether President Trump has the legal authority to remove Fed Governor Lisa Cook. This case represents the first time in the Federal Reserve's history that a president has attempted to fire a Fed governor for cause, setting a precedent that could either safeguard central bank independence or expand presidential control over monetary policy decisions. The Supreme Court's October 2025 decision to allow Cook to remain on the board pending oral arguments marked a significant departure from the justice's previous deference to Trump's removal powers at other independent agencies. Cook will continue participating in Federal Open Market Committee meetings through at least the first quarter of 2026, including the crucial January 27-28 FOMC meeting that will set the tone for monetary policy under intensified political pressure. Cook's case stems from Trump's August 2025 decision to fire her over allegations of mortgage fraud, which she has vigorously denied and for which no formal charges have been filed. The president claims these allegations constitute cause under the Federal Reserve Act, but legal experts argue this represents an unprecedented expansion of presidential authority over Fed governance. The outcome could determine not only Cook's future, but also the broader legal boundaries protecting the Federal Reserve's independence from political interference. The timing of the Supreme Court hearing adds complexity to an already challenging period for the Fed. Just 1 week after the January 21st Supreme Court arguments, the Federal Open Market Committee will hold its first interest rate vote of 2026 on January 27-28. This meeting will test whether the central bank can maintain policy coherence while operating under the shadow of potential political restructuring. Philadelphia Fed. President Anna Paulson's recent comments have provided insight into the Fed's current thinking on monetary policy direction. Speaking at the American Economic Association's annual meeting, Paulson indicated that additional modest rate cuts could be appropriate later in 2026, but only if economic conditions remain benign. I see inflation moderating, the labor market stabilizing, and growth coming in around 2% this year, Paulson stated. If all of that happens, then some modest further adjustments to the funds rate would likely be appropriate later in the year. This cautious approach reflects the Fed's attempt to balance multiple competing pressures. The central bank faces Trump's repeated demands for aggressive rate cuts while simultaneously managing an economy that shows signs of both strength and vulnerability. After 3 consecutive rate cuts in 2025 brought the federal funds rate to 3.5%, 3.75%, market expectations remain modest, with CME FedWatch showing expectations for just 2 quarter-point cuts in 2026. The Federal Reserve's internal dynamics are being reshaped by the annual rotation of regional Fed presidents on the voting FOMC. Starting in January 2026, Cleveland, Philadelphia, Dallas, and Minneapolis Fed presidents gain voting rights, replacing Boston, Chicago, Kansas City, and St. Louis. This rotation introduces new hawkish voices, including Cleveland Fed President Beth Hammack, who has expressed preference for holding rates steady until spring. The personnel changes reflect deeper divisions within the Fed about appropriate monetary policy direction. Recent FOMC meetings have featured multiple dissents, an unusual occurrence that signals the challenges facing Powell in building consensus. The minutes from the December 2025 meeting revealed growing hesitation about further rate cuts among some participants, with several suggesting, it would likely be appropriate to keep the target range unchanged for some time. Wall Street analysts increasingly view the Fed as a potential ticking time bomb for markets in 2026, surpassing even tariff concerns as a source of uncertainty. The combination of political pressure, leadership transition, and internal divisions creates conditions that could lead to policy errors or market volatility. Some economists argue that the Fed's challenges represent a more fundamental threat to economic stability than trade policy changes. The leadership transition dominates speculation as Trump prepares to announce his Fed chair nominee in January. National Economic Council Director Kevin Hassett remains the frontrunner according to prediction markets, with a 43% probability of nomination as of late December. Hassett's advocacy for aggressive rate cuts aligns with Trump's preferences, but raises questions about central bank credibility and independence. Hassett's recent comments reflect his dovish stance. If you look at central banks around the world, the U.S. is way behind the curve in terms of lowering rates. He argues that the artificial intelligence boom will boost growth and put natural downward pressure on inflation, justifying lower interest rates. However, if appointed, Hassett would face the significant challenge of convincing markets that he represents an independent central banker rather than a political appointee. The economic backdrop complicates monetary policy decisions as the Fed attempts to calibrate appropriate responses to mixed signals. After sputtering at the beginning of 2026, the economy grew rapidly in the middle two quarters and is projected to accelerate at a 3% pace in the fourth quarter, according to Atlanta Fed data. AI-related investments have been crucial to this growth, with major technology stocks posting double-digit gains and contributing to overall market strength. This economic strength presents the Fed with difficult choices about appropriate interest rate levels. Lower rates could further stimulate an already growing economy, potentially reigniting inflation pressures. However, higher rates could damage the labor market, which shows signs of softening despite overall economic growth. The challenge is particularly acute given Trump's explicit expectations for rate cuts regardless of economic conditions. The dollar's performance adds another layer of complexity to Fed deliberations. The currency fell over 9% in 2025, its worst annual performance since 2017, reflecting investor uncertainty about American economic policy and Fed independence. Currency weakness could complicate inflation management by raising import prices, potentially constraining the Fed's ability to cut rates, even if other economic indicators suggest such moves are appropriate. Legal experts view the Cook case as potentially establishing crucial precedents for presidential authority over independent agencies beyond the Federal Reserve. The case occurs alongside other challenges to independent agency autonomy, including pending cases at the Federal Trade Commission and National Labor Relations Board. Some observers suggest the Supreme Court could use these cases to overturn Humphrey's Executor v. United States, a 1935 precedent that limits presidential removal powers at independent agencies. The broader implications of expanded presidential authority over the Fed extend far beyond monetary policy to questions of democratic governance and institutional integrity. Central bank independence has been viewed as crucial to effective economic management, allowing monetary policy decisions to be made based on economic data rather than political considerations. Loss of this independence could undermine market confidence and reduce the Fed's effectiveness in managing inflation and employment. International observers are closely monitoring the situation, as Fed independence has been seen as a model for central banks worldwide. The erosion of this independence could influence central banking practices globally and potentially weaken confidence in the dollar's role as the world's reserve currency. Such changes could have profound implications for international financial stability and American economic influence. The AI revolution's impact on monetary policy represents another unprecedented challenge for Fed policymakers. Rapid technological advancement is creating productivity gains that could justify lower interest rates while simultaneously creating new forms of economic disruption that complicate traditional policy frameworks. Fed officials acknowledge they need to better communicate their understanding of these technological shifts and their implications for monetary policy. The mortgage market provides concrete evidence of how Fed policy uncertainty affects real economic outcomes. Despite the Fed's rate cuts in late 2025, mortgage rates remain elevated, with 30-year rates averaging near 6%. The disconnect between Fed policy rates and mortgage rates reflects market uncertainty about future policy direction and the potential for political interference in monetary policy decisions. Congressional oversight adds another dimension to Fed challenges in 2026. Lawmakers from both parties have expressed concerns about the legal basis for Fed operations, particularly regarding military-style enforcement actions and international operations. The lack of specific congressional authorization for some Fed activities creates potential constitutional issues that could further complicate the central bank's operations. Market participants are increasingly pricing in the possibility of policy errors or political interference that could disrupt normal monetary policy transmission. This uncertainty is reflected in volatility across financial markets and complicated planning for businesses and consumers who depend on predictable interest rate environments for investment and borrowing decisions. The Fed's communication strategy becomes crucial as it attempts to maintain credibility while navigating political pressures. Traditional Fed communication emphasizes data-driven decision-making and long-term economic stability, but political demands for immediate rate cuts challenge this approach. Powell's final months as chair will test his ability to maintain institutional integrity while managing unprecedented external pressure. Regional Fed banks face their own challenges as they balance local economic conditions with national monetary policy objectives. The rotating voting structure means that regional perspectives will continue influencing policy decisions, but the increased political scrutiny could affect how regional presidents approach their responsibilities and public communications. The international dimension of Fed policy becomes more complex as other central banks watch American developments with concern. The European Central Bank, Bank of England, and Bank of Japan all rely on Fed policy predictability for their own decision-making. Political interference in American monetary policy could disrupt global financial coordination and complicate international economic relationships. Looking ahead to the remainder of 2026, several key milestones will shape the Fed's trajectory. The January 21st Supreme Court hearing could fundamentally alter the legal framework governing Fed independence. The January 27-28 FOMC meeting will test the central bank's ability to make coherent policy decisions amid political uncertainty. Trump's expected announcement of a new Fed chair nominee will trigger intense analysis of future policy direction. The confirmation process for any new Fed chair will provide another venue for examining questions of independence and political interference. Senate confirmation hearings will likely focus heavily on the nominees' views regarding presidential influence over monetary policy and their commitment to data-driven decision-making rather than political considerations. The stakes of these developments extend far beyond technical questions of monetary policy to fundamental issues of American governance and economic management. The Federal Reserve's ability to maintain credibility and effectiveness while navigating unprecedented political pressure will determine not just interest rate outcomes, but the broader health of American democratic institutions and economic governance. As this historic confrontation unfolds, financial markets, Policymakers and citizens worldwide are watching to see whether the United States can preserve the institutional independence that has been crucial to its economic stability and global financial leadership. The decisions made in the coming months will establish precedents that will influence American monetary policy and democratic governance for generations to come. The Federal Reserve's 2026 challenges represent a fundamental test of the balance between democratic accountability and technocratic expertise in American government. Whether the institution can maintain its effectiveness while adapting to new political realities will determine not just the success of monetary policy, but the resilience of American democratic institutions in an era of increasing political polarization.